John had been investing $5 a day in his portfolio for almost a year. He managed to invest around $1,800, and he was proud of that until he checked his dividend income. Just over $10. $10 after a full year. Is this even working? He wondered. If you've ever started investing and felt like nothing's happening, you're not alone. John feels it too. It's frustrating. He's doing the work, staying consistent, but the growth looks microscopic. That's when doubt starts to creep in and when most people give up. But here's what you don't realize. Dividend investing is supposed to feel slow at the beginning because everything changes after one critical moment, the portfolio hitting the $100,000 mark. In this video, I'm going to take you through John's journey and why dividend investing feels slow at first and what actually changes once you cross the $100,000 mark. You'll see how compounding and reinvesting start to accelerate your returns and why the early stage takes the longest. At the end, I'll walk you through a real-world portfolio that can help you reach $100,000 faster and potentially turn a single $5 investment into a portfolio worth $1.5 million, paying over $5,000 in monthly dividend income. Let's break down the dividend journey, starting with the part no one tells you about. Why does it feel like nothing's happening in the early stages of dividend investing? And there's a simple answer to this. Compounding doesn't show off in the beginning. It gets to work later down the years. Let's go back to John. After a full year of investing $5 a day, he's earned maybe $40 in dividends, if we're being generous. That's like what? A nice dinner, maybe? And when he reinvests those $40, he's not even buying a full share of anything, just a small sliver, a fraction, a crumb. That's the problem with compounding early on. It's doing its job, but the numbers are too small to impress you. Like a snowball the size of a golf ball. Yes, it's technically rolling, but no one's cheering yet. But here's the thing, compounding is sneaky. It builds pressure slowly, and if you stay consistent, that pressure doesn't stay small. It stacks on itself, and then that stacks on itself until you reach a point where the growth is noticeable, usually in 5 to 6-figure numbers every year. This is where a lot of people get tripped up. They expect early investing to feel exciting, to see big results right away, but in the beginning, compounding is like planting a seed and then spending months looking at nothing but dirt. It's doing something, you just can't see it yet. John almost gave up. He looked at his app one night and thought, is $5 even worth it? But then he ran the math. If his dividends grow even 10% a year and he keeps reinvesting, those tiny crumbs eventually start building meals. Those slivers start becoming shares, and the curve starts bending up. And when it bends fast. The trick is sticking with it long enough to see the change, because compounding doesn't care about your feelings, it just cares about time, consistency, and math. If you quit early, you miss the part where it gets good. If you stay, you earn the magic most people never see. So the question becomes, when does this curve finally start to bend? You already know the answer. It starts to turn after $100,000. But why is $100,000 such a big deal? Because it's the moment the math flips, the point where dividends stop being background noise and start becoming a real force. Now, let's say John's portfolio hits the $100,000 mark, and it's yielding about 4%, which is totally achievable with dividend growth stocks and ETFs. That means he's now earning about $4,000 per year in dividends. Divide that by 12, and he's making over $330 per month, just in cash payouts. And here's where things get interesting. Every single month, John's portfolio automatically buys more stock, not just from his $5 contributions, but from the portfolio itself. Those dividends, they're not just returns, they're workers, tiny employees buying more stocks, which in turn increases income for John every month. And after the tipping point, the graph starts to move vertically upward. Finally, John doesn't feel like he's grinding anymore. He feels like he's being pulled forward. And from here, it just gets faster. John used to feel like he was the only one building his portfolio, like every bit of growth came solely from his effort. But now, his portfolio is starting to grow without him and from its own dividends. Every month, his dividend payout increases by $25, then $40, then $60, and he didn't do anything different. No bonus deposits, no new stock picks, just compounding. And here's what's going on. The dividends he's receiving are now large enough to purchase more shares, and those shares immediately start generating dividends too. It's the investing version of cloning your income stream, and every time those dividends are reinvested, the cycle repeats. Faster, stronger, more impactful. It's where the portfolio becomes a machine. Before this point, John's $5 a day was doing most of the heavy lifting, but now those dividends are contributing almost as much, and soon they'll contribute more. The snowball is finally rolling, and the bigger it gets, the more it pushes. The dividends feed the growth feeds the dividends, and the whole engine becomes self-sustaining. That's when your investing shifts from grind to glide. John doesn't have to hustle forever. He just has to stay consistent long enough for the portfolio to take over. And now that it's moving, it's about to pick up speed. Here's the interesting part. The time it took John to go from $0 to $100,000, that was the grind. But now, going from $100,000 to $200,000, that'll take way less time because he's not the only one contributing anymore. His portfolio is doing it with him, and soon enough, it's doing it for him. Remember, John's still only contributing $5 a day, but his dividends? They're adding hundreds every month. And within a few years, those dividends will be adding more to his portfolio than John himself does. This is what people mean when they say, your money starts working for you. His stocks aren't just paying dividends, they're also growing in value. So not only is his dividend income rising, but his portfolio balance is climbing even faster. It's the best of both worlds, income now and growth later. The result? Exponential growth, a curve that used to be flat now becomes vertical. This is the phase where people watching from the outside say, man, you're lucky. But it wasn't luck. It was patience, strategy, discipline, and time. And most people, sadly, never get here. They quit somewhere between year 2 and year 7, right before the compounding magic starts to happen. But John stuck with it. He pushed through the invisible years, and now the system is doing the pushing. In the end, I'll walk you through a real-world portfolio that can help you reach $100,000 faster and potentially turn a single $5 investment into a portfolio worth $1.5 million, paying over $5,000 in monthly dividend income. Next, we'll show you exactly how John built the portfolio that got him here and how you can do it too. The stock selection for the portfolio comes down to a few key principles, ones that you can apply right now. John focused on what actually matters in dividend investing: quality, growth, and consistency. He wasn't looking for the highest yields. He was looking for companies that could grow their dividends reliably over time without cutting them during tough years. And that's where this 5-stock core portfolio came in. The first is Schwab U.S. Dividend Equity ETF, which offers a 3.73% current yield, a 10-year dividend growth rate of 10.77%, and annual price appreciation of 8.52%. SCHD acts as the steady foundation, reliable, diversified, and the bedrock of a dividend snowball. Then there's AbbVie, a healthcare giant paying a 2.95% yield with a strong 12.86% dividend growth rate and 14.12% annual appreciation. AbbVie adds stability and income backed by one of the most resilient sectors. Lowe's might not have the highest yield at 1.81%, but with 16.97% dividend growth and 14.31% price appreciation, it's become a compounding powerhouse. On the growth side, NetEase contributes a 1.91% yield, a massive 24.82% dividend growth rate, and 20.78% annual appreciation. This stock is the engine of acceleration in the portfolio. Lower starting yield, but explosive growth potential that compounds fast. Finally, Tractor Supply brings a 1.54% yield, 20.25% dividend growth, and 13.39% annual appreciation. It may not look like much up front, but the pace of its dividend increases makes it a hidden powerhouse for long-term income. Together, these 5 positions give John the perfect mix: immediate yield from SCHD and AbbVie, rapid dividend growth from Lowe's, NetEase, and Tractor Supply, and reliable price appreciation across the board. As a team, they complement each other. And John isn't overweighting any single company. Instead, he's setting them up as 5 equal slices of the pie, diversified across different sectors with strong track records and predictable growth. And as he invests, he's making a key decision. Every dividend gets reinvested. He's not spending them. He's not cashing out. He's treating them like fuel for the machine. Every payout will buy more shares, and every new share will start generating more payouts. This cycle, contribution, dividend, reinvestment, repeat, is how he's turning just a few bucks a day into something powerful. It's simple math, but it only works if you give it enough time to breathe. The magic isn't in finding the perfect stock, it's in sticking with great ones, reinvesting consistently, and letting time do its job. If John continues building his portfolio this way, focusing on quality first, reinvesting everything, and ignoring the noise, he won't need to check it every day. He'll just need to stay in the game long enough to watch it take off. And that is exactly what we're about to do. We'll find the portfolio metrics and we'll plug this exact portfolio into a long-term projection and see what happens when this snowball finally starts building serious momentum. So let's calculate the portfolio's metrics so we can see how strong this snowball really is. Let's start with the portfolio's dividend yield. To calculate it, you simply take each stock's current yield, add them up, and then divide by the number of stocks. For example, SCHD has a yield of 3.73%, AbbVie 2.95%, Lowe's 1.81%, NetEase 1.91%, and Tractor Supply 1.54%. If you add all those together, you get 11.94%. Divide that by 5 since we're using equal weighting, and you land at an average portfolio dividend yield of 2.39%. That's the blended yield across the entire portfolio. You can use this exact same method to calculate other portfolio averages like dividend growth and share price appreciation. If we do that for John's portfolio, we find an average 17.13% dividend growth rate and an average 14.22% annual share price appreciation. Now let's see what happens when we let it run with John's daily $5 contributions. Same 5 investments, same rules, with reinvesting every single time dividends are paid. Here's how it'll play out. After 1 year, John will have contributed $1,825. It won't feel like much, and his dividends will still be just a few dollars. By year 10, however, his contributions of $18,250 will have grown into a portfolio worth $40,996. He'll already have more than doubled the amount he put in. By year 15, John will cross the $100,000 milestone, and this is where the compounding will really start to show itself. By year 20, his total contributions of $36,500 will have grown into $254,882. The snowball will be visibly rolling on its own now, and by year 30, that same $5 a day habit will have snowballed into an incredible $1,504,727. Also by year 30, the portfolio will be paying out $68,939 per year in dividends. That's $5,745 every single month, enough to cover rent, pay bills, travel, and even replace a full-time income for most people. Out of that $1.5 million total, $1,082,846 will come from capital appreciation, $367,132 will come from reinvested dividends, and only $54,750 will come directly from John's own pocket. So now that we've seen the projections, let's bring it to life with this graph. Take a look. This line represents John's portfolio, growing year after year with just $5 a day. At first, it's nearly flat, almost boring, but right here, right around year 15, John finally crosses the $100,000 tipping point. And by then, the pace begins to accelerate. By year 19, his portfolio reaches $200,000, meaning the second $100,000 comes in just 4 years instead of 15. By year 21, he's already at $300,000, which means the third 100 arrives in only 2 years. 3 years later, by year 24, he's broken through $500,000. And at year 27, the snowball is adding $200,000 in the same time it once took to add just one. By year 28, John's portfolio has passed the $1 million mark, and by year 30, he's sitting at $1.5 million. That's a $500,000 addition in just 2 years. This is why the first $100,000 is the tipping point. What once felt like an uphill grind before $100,000 turns into snowball acceleration after. What took John 15 years to build in the early stage now happens in just a couple of years, and eventually, the portfolio is adding hundreds of thousands without him even touching a thing. Want to know which 50-50 ETF combo has crushed the S&P 500 for 10 straight years? Click the video on the screen to find out.